Selling your assets and running to cash during a market crash feels like the safest thing you'll ever do. It is very often the most expensive. Because when you liquidate into a panic, you don't avoid the loss, you make it permanent. Up until the moment you sell, a decline is a number on a screen, a temporary repricing of something you still own. The instant you sell, it becomes a realized loss, a tax event, and a hole your portfolio now has to climb out of from a smaller base. And here's the part that quietly does the real damage. The money you move to cash stops compounding. Not for a week, for however long it takes your nerves to recover, which history says is usually far longer than it takes the market to. So today, we're dismantling the panic impulse entirely. I'm going to walk you through the 3 mistakes that hurt investors most during volatile cycles, what the historical data actually says about recoveries, and the systematic strategies that let you respond to turbulence with rules instead of adrenaline. I'm Reza Zamani, and I want to start by naming what volatility really is, because the framing determines everything that follows. Most people experience a market downturn as a signal something is wrong, act now. But volatility isn't a signal. It's the admission price. It is the fee you pay in discomfort for returns that historically have exceeded what cash and bonds deliver over long periods. Nobody gets the long-term returns without paying that fee. The only real question in a downturn isn't whether you'll experience the volatility you already are. It's whether you'll pay the fee and keep your seat, or pay the fee and leave. Because the investor who sells in the drawdown pays the full cost of the decline and receives none of the recovery. That's the worst trade in the entire market, and it happens by the millions every single cycle. Standard disclosure before we go further: this is education, not personalized investment advice. Everything I described today depends on your specific situation, time horizon, and risk tolerance. All examples are hypothetical illustrations. Past performance never predicts future results. And investing always involves risk, including possible loss of principal. Work with a qualified professional before making changes. All right, mistake number 1. Mistake number 1 is emotional panic selling. And I want to be precise about why it's so destructive. Because don't panic sell is advice everyone has heard and almost nobody can execute in the moment. Here's the mechanism. Picture a hypothetical investor with a $1 million portfolio in a sharp 30% drawdown. On paper, they're down $300,000. It feels unbearable, so they sell everything and move to cash to wait for clarity. Now, watch what actually happens next. The $300,000 is no longer a fluctuation, it's realized, gone, and if that sale happened in a taxable account, they may owe taxes on top of it. Their remaining $700,000 now needs a gain of roughly 43% just to get back to even, because losses and gains are asymmetric. And climbing back from a smaller base always requires a bigger percentage move than the one that knocked you down. But the deeper problem is the second decision, the one nobody plans for. Getting out is one decision. Getting back in is another, and it's far harder because there is never a bell that rings at the bottom. The headlines at the bottom are the worst headlines of the entire cycle. So our hypothetical investor waits for things to feel safe. And by the time it feels safe, a substantial portion of the recovery has already happened without them. They paid for the entire decline and bought back in for a fraction of the rebound. And this is exactly where the historical data becomes so important, because it explains why that pattern is so punishing. Decades of market history show something counterintuitive. The market's very best single days have a strong tendency to cluster inside its worst periods, often within days or weeks of the sharpest declines. Violent rallies happen in the middle of frightening markets, not after everything has calmed down. Study after study on long-term index returns has found that an investor who stayed fully invested through a multi-decade period ended up meaningfully ahead of an investor who missed only a small handful of the market's best days, and those best days were overwhelmingly concentrated in exactly the stretches when selling felt most justified. Think about what that means structurally. The recovery isn't a slow, gentle ramp that gives you time to notice it and rejoin. It's frequently front-loaded, explosive, and it arrives while the news is still terrible, which means the investor sitting in cash waiting for confirmation is, by design, positioned to miss the highest value days of the entire cycle. Patient capital doesn't get rewarded because patience is a virtue. It gets rewarded because it's present on the days that matter, and nobody knows in advance which days those are. So, how do you actually stay present when your account is bleeding? Not with willpower, with attention management. Here's the practical shift. Stop measuring your portfolio against yesterday and start measuring it against your target. Daily fluctuation is noise with no informational content about your 30-year outcome. If you're 16 years from retirement, the only genuinely relevant question during a downturn is whether your plan still gets you where you're going. And the honest answer, in the overwhelming majority of diversified long horizon plans, is yes, provided you don't interrupt it. So change what you look at. Check your progress toward your funding targets quarterly or semi-annually instead of checking prices daily. Write down, right now while markets are calm, exactly what you will do if your portfolio drops 20, 30, 40%, because a decision made in advance in a rational state is worth 10 decisions made at midnight with a red screen in your hand. And build the buffer that makes patience possible. An appropriate cash reserve sized to your real expenses so a downturn never forces you to sell investments to cover life. Most catastrophic panic selling isn't really about fear of markets. It's about a liquidity structure that left someone no choice. Fix the structure and the emotion loses its leverage. Mistake number 2 is the opposite failure, and it's the one that flies completely under the radar, failing to opportunistically rebalance. Panic selling is the sin of doing too much. This is the sin of doing nothing, and it quietly reshapes your risk without your consent. Here's how it happens. In a long bull run, your winners grow into a larger and larger share of your portfolio. A hypothetical investor sets a 70-30 stock to bond target, stocks run for 3 years, and now the portfolio sits at 82-18. Nobody made that decision. The market made it for them, and they are now carrying materially more risk than they chose at exactly the moment their winners are most expensive, which is precisely why the next downturn hits them harder than their plan ever intended. The mirror image is just as costly. When an asset class gets hammered, disciplined investors are supposed to buy more of it to restore the target. That is when future returns are mechanically on sale. Investors who freeze and skip that step don't just avoid discomfort, they cap their own upside in the recovery. The fix is threshold-based, automated rebalancing, and it's beautiful precisely because it takes the decision away from you. You set a rule in advance. Whenever any asset class drifts more than 5 percentage points from its target, rebalance back to target. Or you rebalance on fixed dates semi-annually, annually, regardless of what the headlines say. Either way, you've built a machine that mechanically trims what's grown expensive and adds to what's fallen out of favor. It forces you to sell high and buy low, by rule, with no forecasting, no market calls, and no emotion. And notice how differently this behaves in a crash. The panic seller looks at a 30% decline and sees a reason to abandon the plan. The rebalancer looks at the same decline and sees their rule quietly, instructing them to buy not because they're brave, but because the drift threshold triggered. Same market, same fear, completely different action, entirely because one of them decided in advance. 2 more things make this routine even more powerful during turbulence. The first is systematic tax loss harvesting. In a taxable account, a downturn creates a genuine opportunity. You can sell a position at a loss, immediately reinvest the proceeds into a similar but not substantially identical investment so you stay fully invested and don't miss the recovery. And bank the realized loss to offset current or future capital gains, and within annual limits, a portion of ordinary income. You've maintained your market exposure while converting a paper loss into a real usable tax asset. It's one of the few things a downturn hands you for free. The rules here are technical wash sale rules in particular are strict and easy to trip. So this is a coordinate with your tax professional move, not a wing it move. The second is that disciplined rebalancing naturally generates liquidity because trimming positions that have run creates proceeds. That's what funds your targeted adjustments, deliberate, planned moves into areas your strategy calls for, rather than scrambling for cash at the worst possible moment. Which brings us to mistake number 3, ignoring the modern drivers of volatility and treating today's market with a decades-old mental model. Many investors are still operating on correlation assumptions, inherited from an earlier era, the reliable belief that when stocks fall, bonds rise, that geography reliably diversifies, that sectors move in familiar relationships. Those assumptions have been strained repeatedly in recent years. We've lived through periods where stocks and bonds fell together, which is precisely the scenario the classic model says shouldn't happen. And the forces moving markets today are genuinely different in character. Artificial intelligence isn't just a sector, it's a disruption, vector reshaping cost structures and competitive position across nearly every industry, creating winners and losers in places that look unrelated on an org chart. Global supply chains are being rewired around geopolitics rather than pure efficiency, which changes input costs and margins in ways that don't show up in historical correlation tables. And central bank policy has become a dominant, fast-moving driver of asset prices across the board. None of that means the fundamentals of investing changed. It means the diversification you think you have deserves an actual audit rather than an assumption. So what do you do with that? Not predict, construct. The goal is a framework with genuinely different sources of return so that a single macro shock doesn't hit everything you own simultaneously. In practice, that usually means examining whether your portfolio is more concentrated than it appears and considering exposure to businesses with durable, resilient cash flows, companies whose earnings are less sensitive to the economic cycle, which historically have tended to buffer drawdowns while keeping you invested and participating. Notice the framing. Buffer, not exit. The point is never to leave the market before trouble. Nobody reliably does that. The point is to build something that can absorb a shock without forcing you into the panic selling behavior we spent the first half of this video dismantling. Resilience is what makes discipline survivable. I'd add one caution. This is exactly the territory where dynamic framework can quietly become an excuse for market timing dressed up in sophisticated language. The test is simple. If your adjustment came from a written policy and a scheduled review, it's strategy. If it came from a headline and a feeling, it's a prediction wearing a costume. Be honest with yourself about which one you're doing. So let me pull all of this together because the 3 mistakes share a single root. Panic selling is emotion overriding the plan. Failing to rebalance is inertia overriding the plan. Ignoring modern volatility drivers is an outdated plan overriding reality. In every case, the failure isn't intelligence or information. It's the absence of a written, automated system that decides in advance so you don't have to decide in the moment. Here's your action plan. Write your volatility policy today. While markets are calm, the exact drawdown levels, the exact rebalancing thresholds, and the exact response to each in writing before you need it. Automate what you can, so contributions and rebalancing continue whether or not you're feeling brave. Set your review cadence to semi-annual and honor it, so you're responding to data rather than headlines. Size your cash reserve so a downturn can never force your hand. And coordinate tax loss harvesting with a professional, so turbulence generates something useful instead of only anxiety. The market will test you. That's not a risk in your plan. It's a feature of the asset class. And it's precisely why long-term returns exist in the first place. The investors who come through these cycles ahead are almost never the ones who predicted correctly. They're the ones who decided in advance, wrote it down, automated it, and then let the plan do exactly what it was built to do while everyone else was reacting. Discipline isn't glamorous. It just compounds. If this gave you a framework you can actually use, subscribe and hit the bell. We turn professional grade strategy into plain playbooks every week. I'm Reza Zamani. Decide in advance. Stay in your seat. I'll see you in the next one.